Hey everyone, ready to dive into something exciting? Today, we're on the hunt for multi-bagger stocks.
Those elusive stocks that could potentially make your portfolio do a happy dance.
Right, exactly. We're talking about the kind of returns that feel almost mythical, like finding a unicorn in a field of horses, the ones that make investors do a victory lap.
You know, the legendary investor Peter Lynch actually coined that term, multi-bagger.
Really? I didn't know that.
Yeah, he said it's any stock that returns a multiple of your original investment. So double, triple, even 10 times your money.
Okay, so how do we even begin to uncover these unicorn stocks?
Well, we're diving into the work of Paul Andreola.
Okay.
He's an investor who's developed a really fascinating approach for identifying these potential multi-baggers, especially among smaller companies.
So is there like a secret formula he uses?
It's not exactly a secret formula, but it is a process. He calls it the small cap discovery cycle. And it's based on this idea that there's a pattern to how certain promising small companies get discovered by the market and just kind of explode.
Kind of like a treasure map.
Exactly, yeah. A treasure map leading to those hidden gem companies.
I like the sound of that. So how does this cycle work? Break it down for us.
Okay, so it all begins with what Andreola calls the pre-discovery phase.
Oh, okay.
Imagine a company that's totally under the radar, right? Relatively unknown. They're too small for those big institutional investors to even notice. But they're doing something intriguing, something different.
So they're like a diamond in the rough just waiting to be discovered, huh?
Precisely, yeah. They're just waiting to shine. And that's where the catalyst comes in. This is the second phase.
Gotcha.
Andreola, he looks for companies that have impressive sales growth, like 25% or more year over year.
Wow, that's fast.
Right, and here's the crucial part. They're also showing their second consecutive quarter of profitability. So it's not just about growth, it's about profitable growth.
Okay, so it's about proving they can actually turn a profit consistently. Why the emphasis on 2 consecutive quarters? Why not just one good quarter?
You know, that's a really good question, and it's where Andreola's approach seems to connect with some very compelling research on what really drives long-term stock performance.
I'm intrigued. Tell me more.
And it all boils down to a metric called return on invested capital, or as it's more commonly known, ROIC.
ROIC. Okay, I've heard that term before, but I could definitely use a little refresher.
Mm.
What is ROIC exactly, and why should we care about it?
So in the simplest terms, ROIC measures how effectively a company used its investments to generate profit.
Okay.
Think of it this way. A company with a high ROIC, it's like a really amazing chef. They can take, just a few simple ingredients and turn them into this incredible meal.
Oh, happily.
They're using their resources really wisely to create something truly valuable.
I love that analogy. So high ROIC, good. Low ROIC, not so good. But how does this tie back to Andreola's focus on those consecutive profitable quarters? What's the connection there?
So this is where it gets really insightful. A recent study found a really strong link between a company's ROIC trajectory and its stock market returns. That's TSR, by the way.
Right, TSR, total shareholder return. Got it.
Exactly. So the most significant stock price growth often happens when a company transitions from, let's say, a low ROIC to a higher ROIC. Essentially, they go from, maybe struggling to generate decent profits to becoming much more efficient and much more profitable.
So they're like a restaurant that figures out how to make their kitchen run more smoothly, and suddenly they're serving up Michelin quality food. They're more profitable because they're using their resources much more effectively.
That's a fantastic way to put it. You've got it. And Andreola's strategy seems to target this exact transition phase. Companies that are demonstrating their second consecutive profitable quarter, they might be signaling that they're figuring out their business model, and they are poised for an upward ROIC trajectory.
So Andreola is basically betting on those under-the-radar companies, the ones about to transform their ROIC, right? It's
Yeah.
like finding a caterpillar that's about to become a butterfly, right? Amazing potential, but then what? This company, it's still pretty small at this point.
Absolutely. Still in those early stages, that's exactly what Andreola looks for.
Makes sense. I mean, if everyone already knew about this company, the stock price would already reflect that, right? Those multi-bagger gains would be long gone. So how does this little caterpillar, or this company, I should say, how do they start to get noticed by investors?
So as they keep, stacking those profitable quarters, they move into the next phase of the cycle. Andreola calls this retail investor interest. Word starts to get out, maybe through those investment newsletters, online forums, word of mouth. People start talking.
Right. So it's individual investors, maybe some smaller funds. They start noticing these impressive numbers. And then what?
Yeah, and as more of these investors buy into the company's story, well, the stock price starts to rise naturally. The company's market cap grows,
Yeah.
right? And that's when it starts attracting the attention of those larger, more institutional investors.
Okay, so that brings us to institutional investment, the next phase.
Exactly, yeah.
Right.
This is where the big money comes in. Those mutual funds, the hedge funds, they've got serious capital to deploy.
Right, right.
And when they start buying in, it can have this like snowball effect on the stock price.
Yeah.
Because these big investors, they're looking for companies that are going to generate those significant returns. And a strong, positive ROIC trajectory is a big green flag for them.
So it all connects now. Andreola is looking for those companies that are on the verge of improving their ROIC because he knows that's a major driver of long-term stock performance, and that's what attracts those big investors who can really push the price up, right?
Yeah, exactly. And then, as this company gains more and more recognition, it might get added to those major stock indexes, which just attracts even more investors. That's full discovery, the final stage.
And that's Andreola's cue to maybe start thinking about selling.
Yeah, he suggests it might be a good time to consider it because that most explosive growth phase, it might be coming to an end.
Interesting. Okay, so we've got this 5-phase cycle. Andreola identifies these promising small cap companies just as they're demonstrating that profitability, those higher ROICs, attracting bigger investors, and then they hit that full discovery. It all makes sense, but there's one thing I'm still kind of stuck on. He also looks for companies with 25% year-over-year sales growth. Isn't that, I don't know, really fast? I mean, can that even be sustained?
Yeah, that's a really good point, and you're right to question it. While Andreola, he sees that 25% growth as, a sign of that momentum, some really successful investors like John Neff, for example, they were actually wary of companies growing that fast.
Oh, really? Interesting.
Yeah, because remember, it's not just about growth, it's about sustainable growth, right? The kind of growth that leads to that consistently improving ROIC over the long term.
So it's like the difference between, I don't know, a flash in the pan and like a slow burning fire, right? One's exciting for a minute, but the other one can provide warmth for years.
What a great analogy. That's exactly right. And that's actually a good point to bring in the perspective of Chris Mayer. He's another investor who's built a really impressive track record finding those multi-bagger stocks.
Okay, and what's his take on this?
So Mayer, he argues that while focusing on smaller companies can be, good place to start, getting too fixated on a company's size, you might actually miss out on those slow-burning fires.
I like that. So it's not just about finding those tiny companies that are poised for, explosive growth. It's about finding any company, regardless of size, that can generate those really strong returns over the long haul, right?
Precisely. And he says the most critical factor in a company's multi-bagger potential, it all comes down to the rate at which it can compound its capital.
Compounding capital. That's got a nice ring to it. Okay, so remind us again what that means and why it's so important for investors.
Okay, so imagine a snowball rolling downhill. Start small, but as it rolls, it picks up more and more snow. It gains momentum. It gets bigger, right?
Right.
That's the power of compounding. In investing, it means, a company is taking its profits and reinvesting them effectively. Those profits generate even more profits. They reinvest again, and so on and so on. It's a cycle of growth.
That's the dream, right?
Exactly. And the best part, this cycle, it can happen in companies of all sizes. It's not just limited to those small cap companies that Andreola focuses on.
Okay, that's a good point.
Yeah, and Mayer's point is that if we're too busy, fixated on market capitalization, we might miss those companies that are already pretty well established. But they still have enormous growth potential because their snowball is already rolling, right? And it's only picking up speed.
This is where it all comes together for me. Okay, so we have Andreola's small cap discovery cycle, which is kind of like, it's guiding us towards those companies that are showing early signs of profitability, maybe those higher ROICs. And then we can layer on top of that Mayer's focus on this capital compounding, which is encouraging us to look for, companies, again, regardless of their size, that have this proven track record of reinvesting their profits wisely. Like, we've got the best of both worlds, right?
That's a great way to put it. You've got to think of it like Andreola's approach. It helps you kind of narrow down the playing field a little bit, right? You start to identify those potentially undervalued companies, maybe those hidden gems.
Yeah.
And then you use Mayer's insights, and it gives you the tools you need to evaluate those companies. Do they have what it takes to really generate those multi-bagger returns over time?
So as we start to wrap up here, what are some key takeaways our listeners should remember as they, go on their own multi-bagger hunt.
I think the biggest takeaway is you got to combine these powerful concepts that we've been talking about into your own investment strategy, right? Look for those companies that are transitioning to profitability because that's a good sign. It signals that there might be an upswing in their ROIC coming, but, and this is important, don't stop there, right? You got to dig into those financials, see how well they're actually reinvesting their profits. How is that management team? Do they have a solid track record of making, smart decisions with the company's money? Because those are the clues that you just might have found a real multi-bagger.
Well, I gotta say, this deep dive has given us so much to think about. We talked about Andreola's small cap discovery cycle, the importance of ROIC trends, and how powerful compounding capital can be. It's like we've got this toolkit now to help us find those companies with, unicorn potential. But here's a final thought for you to ponder as you continue on your investing journey. How can you develop your own filters, your own set of criteria that works for you for finding those multi-baggers that are hiding in plain sight?